Hi everyone, and thank you for tuning in to watch this video. Today I'll be diving into how a first home buyer can successfully purchase a property with a $90,000 annual income and just $26,000 in savings. Now, whether you're just starting your journey or you're looking for practical strategies to make your dream of home ownership a reality, this guide will show you how it can be achieved using government schemes and smart planning. So let's get started. So as mentioned in this example, our applicant is earning $90,000 per year. She has no dependents, $26,000 saved towards her deposit, and no existing liabilities. Importantly, she qualifies for all available first home buyer schemes in New South Wales, giving her a strong foundation to enter the property market. The property she is looking to purchase will cost no more than $450,000. Her $26,000 in savings will meet the 5% deposit requirement under the First Home Guarantee Scheme. And again, because she qualifies for the First Home Buyers Assistance Scheme in New South Wales, she won't have to pay any stamp duty on a purchase, which will save her just shy of $15,000. Now, moving on to her financial situation, and at the time of this recording, the borrower can finance $427,500 at an interest rate of 5.89% per annum. This will result in monthly principal and interest repayments of $2,533. The loan-to-value ratio, or LVR for short, sits at 95%, meaning the loan amount represents 95% of the property's value. Thanks to the first home guarantee, no lender's mortgage insurance, short for LMI, is going to be needed, which again will help with thousands of dollars upfront. On this slide, we have the applicant's monthly income displayed both before and after tax. Her monthly living expenses, which will include costs such as food, entertainment, transport, groceries, and communication, have also been factored in. Based on this proposed home loan repayment of $2,533 per month, she would still have a healthy surplus of $1,183 each month after covering her living cost as well as her mortgage repayments. Now, it's important to note that depending on the type of property you purchase, other expenses need to be factored in. For example, apartments, they generally have strata fees that also need to be considered. The property purchasing funding summary shows that $453,200 are needed to complete the purchase. This will include estimated costs such as legal fees, property inspections, as well as title-related charges. Because she has $453,500 available, which is basically the loan amount that she's borrowing, as well as the savings that she has available for the deposit, it demonstrates that she has sufficient funds to complete the property purchase with a small surplus of $300 remaining. Now, although this is showing that she has enough funds to complete the purchase, it is wise to have a larger surplus available after she purchases the property. And this is really helpful should there be any unexpected cost or if there are any emergencies that arises after she purchases the property, that she has some cash left over. As we can see, the outcome is very positive. The applicant fully meets the deposit requirements, serviceability, and overall affordability criteria. Her loan repayments are very manageable, with a surplus at the end of each month, giving her financial breathing room. Now, overall, she's ready for home ownership, supported by a strong budget, sufficient funding, and access to government schemes that reduce her upfront cost. This will put her in a confident position to successfully purchase her first home and manage her mortgage comfortably. So to recap, she was able to access the First Home Guarantee, which allowed her to purchase the property with just a 5% deposit without the need to pay lender's mortgage insurance. Now, she also benefited from the First Home Buyers Assistance Scheme, saving her a significant amount by not having to pay stamp duty. Together, these government initiatives made home ownership much more achievable and affordable. This video was created to help first home buyers realize that home ownership is actually much closer than many people think. By understanding where you are today, identifying your goals, and applying the right strategy to bridge the gap, owning your first home is possible. As we've shown through this example, with a $90,000 income per year, it is achievable. With the right planning, support, and guidance, you can get there. See, it is important to highlight some of the common mistakes that first home buyers should be aware of. First, not managing or regularly reviewing your cash flow. Staying on top of your budget is critical to ensuring you stay on track with your repayments, as well as being able to live your life. Second, not managing or annually reviewing your home loan products. Your home loan is going to evolve with your circumstances, so regularly check in to make sure it remains competitive. In other words, shop around if need be, or even contact your existing lender and ask them to review your interest rate. Number 3, not considering any insurances. See, life is going to be unpredictable, and the right insurances can provide important protection for your home. See, not only the home and contents insurance, which will protect the belongings as well as the structure of your home, but you should also at least consider life insurances. For example, there are insurance policies called income protection, life, disability, or trauma insurances, which a qualified financial advisor will be able to guide you through. But essentially, you need to protect you so you can continue to live where you are. Number 4, not reaching out to your broker or lender when an issue arises. Don't wait until small problems become a major one. Getting help early can make a big difference. Finally, not reviewing your loan when significant changes occur, like changes in your employment, income, or any other personal circumstances. Make sure to always stay proactive, which will help you to protect your investment as well as your financial future. Here are some tips that can really help you smoothen the process when buying your first home. Firstly, use an experienced mortgage broker who is willing to learn about your situation and really wants to know about where you are now, but also where you want to be in the future. You want to make sure that they can guide you through the process and clear up any questions that you might have. Always get a pre-approval before making any offers. This will give you much greater confidence as well as negotiating power. Number 3 is a big one. Make sure you engage a professional conveyancer or solicitor to handle the legal side of the transaction properly. Fourth, make sure you do your thorough research on the area as well as surrounding suburbs that you're considering to buy into. Also, make sure that you inspect the property at different times of the day to get a full picture of the environment and neighborhood that you're purchasing. Now, think about your future plans, whether you plan to either live there for the long term or if you plan to eventually turn it into investment. In either case, a good tax advisor will be very helpful. Finally, the home loan comparison rate can show you the true cost of the life of the loan. This slide shows us the standard repayment schedule over a 30-year loan term. Now, based on a loan amount of $427,500 at an interest rate of 5.89% per annum, the minimum monthly repayment is approximately $2,533. Over the life of the loan, the total interest that is charged will be around $484,353, bringing the total repayments to $911,853. As it can be seen in the pie chart, a significant proportion of the repayments will actually go towards the interest only, more than half of the total amount paid. So on the minimum repayments alone, it will take 30 years to completely pay off the home loan. This highlights why it's so important to have a good repayment strategy in place to really reduce the cost wherever possible. This graph shows you how the loan balance reduces over the 30-year loan term with the standard minimum repayments. In the initial years, most of your repayments go towards paying interest rather than reducing the capital. Now, during the middle period of the loan, a greater portion of each repayment gradually starts to repay down the principal balance. And in the final years, the principal reduction accelerates significantly as the interest proportion becomes much smaller. This is a typical repayment pattern for standard principal and interest home loan, and it highlights the importance of considering extra repayments early if you want to pay off the home loan faster and save on interest. One powerful strategy to pay off your home loan faster is really just to make extra repayments. See, in this example, by paying $500 extra per month, the loan term actually reduces by close to 10 years. It's actually 9 years and 11 months of the mortgage. But not only that, it also saves you over $182,000 in interest, reducing the total interest bill to around $301,663. So if you were to make the additional repayments, your monthly repayments would be $3,033. So as you can see, by making additional repayments today can actually lead to massive savings over the long term and really help you to get financially free earlier. In this graph, it clearly shows the difference between making just the minimum repayments versus paying an extra $500 per month. Now this is applicable to this loan of $427,500. Again, with the standard repayments, you're looking at $2,533 per month. The loan would take 30 years to pay off, and the interest is about $485,000. However, by adding the $500 extra per month, your monthly repayments will be $3,033, but the loan will be paid off in just over 20 years. So as you can see by the strategy, you would reduce the total interest paid to just under $302,000, saving you over $182,000 in interest. Now this highlights just how powerful extra repayments can be when you decide to make extra repayments into the home loan. That's a wrap all. Thank you very much for watching. If you'd like to learn more about buying your first home or how to invest into your next property, make sure you stay connected with us. Feel free to comment below with any topics that you'd like us to cover next. And it'll mean a lot if you can subscribe to this channel, because that way we can create more content to help you about financing your next property. Thanks again and take care.